This is comprehensive problem number 2 from chapter 2. This is the comprehensive problem on how to create a worksheet. On December 31st, Miller issues 50,000 shares of its $20 par common stock for all the outstanding shares of Richmond. As part of the acquisition agreement, Miller agrees to pay the former owners of Richmond $250,000 if certain profits projections are realized over the next 3 years. Miller calculates his acquisition date fair value of the contingency at $100,000. In creating the combination, Miller pays $10,000 in stock issuance costs and $20,000 in accounting and legal fees. Below is the information on December 31st on acquisition date of the book values of both Miller and Richmond, and then the fair value of Richmond. Miller stock has a fair value price of $32 per share. Using the acquisition method, prepare the journal entries as if Miller dissolves Richmond and it no longer exists. And then 2, instead, we'll prepare that they maintain separate legal corporations and 2 different accounting systems. So then we would have to prepare a consolidated worksheet. Okay, so step 1. I'm going to take this information here, and I'm going to go down here and I'm going to figure out the purchase price. The very first thing we have to do is figure the differences between fair value and book value. Okay, so we'll use these differences in the purchase price. So it says that Miller agrees, issues 50,000 shares of $20 par value, $32 fair value stock. So purchase price. So common stock equals 50,000 shares times $20, and then additional paid in capital. This is the difference between the fair value and the book value of the common stock times the number of shares. We'll need an equal sign here. And then the contingent liability. And we take the fair value, estimated fair value on the date of acquisition, which is $100,000. Total purchase price. Okay, so there's our total purchase price. Book value. So now we need to find the book value of Richmond, which is assets minus liabilities. This is book value, sorry. These are already in negative form, so they're already in minus. So that's the book value of Richmond. Now we figure out what our excess over book value is, and that is our total purchase price minus our book value. So our excess is $1.1 million. Then we have to first attribute it to assets. and liabilities here. So I'm just going to copy these. So it's minus 10 on the receivables. And then 220 on inventory. And this is the difference between fair value and book value. 100 on patented technology. 500 in process R&D. 100. And there was no income. So total consideration transferred to assets. And then the difference is goodwill. So it's the excess minus that we can contribute to assets equals goodwill. So now we're going to do part 1. And part 1 says, prepare the journal entries necessary if Miller dissolves Richmond and it no longer exists. So if Miller dissolves Richmond, we will have to write on Richmond's assets to Miller's books at their fair value. So that's 200,000, right? Then we have cash was 200,000. It's 290 for receivables. Inventory is 820. Building net of depreciation is 900. Unpatented technology is 500. In process R&D is 100. Accounts payable is 200. And notes payable is 1.1 million. Let's see if each of these sides together. What we will have to also write on is what we figured out here, which is goodwill. And we'll also have to write on the purchase price. And the contingent liability was, oops, it was 100,000. Common stock, it's 1 million. Additional now let's see. And our debits and credits are equal, which is necessary to balance the equation. And we've accounted for all of their assets, as well as the goodwill on the purchase, as well as the purchase price, which is the contingent liability, common stock, and additional paid-in capital. We do have to remember that we had, if you go back to the top of the problem, Miller also pays $10,000 in stock issuance costs and $20,000 in accounting and legal fees. We will have to take care of this. So the $10,000 stock issuance costs reduces additional paid-in capital. And we, of course, reduce cash because we actually pay these. And then the accounting and legal fees. We put that to expense. It's 20,000. And we remove the cash. If I could say. So this would be the entire part one if they actually had dissolved Richmond. So part two says, assume instead that we retain a separate legal entity. So I'm going to copy all this. Okay, so the purchase price is still the same, even if we retain separate legal entities. Now, instead of writing on the assets when we purchase, we're just going to write on the fact that we purchased them, and we're going to call it investment. Make sure this whole thing is 14. So, part 2. This is going to be the journal entry. So, we recognize the purchase. We call it investment in Richmond. And it's the total purchase price. And then on the other side of this, we have common stock, additional paid-in capital, and contingent liability. Now we also have the accounting and legal fees and the stock price acquisition cost, stock cost. So additional paid-in capital. This is the amount of the stock issuance cost, which was 10,000. And we remove cash, because we paid for that. And then we also have the accounting legal fees. These would be the journal entries that we would make for the purchase. Now, since we have to retain separate legal entities, we also have to make consolidated worksheet entries. Now, consolidated worksheet entries. We are going to A, writes on the fair value and reduces the investment account. So what we're going to do is we're going to write down the fair value differences. So we had calculated these before, I must not have copied them. But so these are going to be part of consolidation entry A, which is right on fair value and reduced investment account. At the end of our consolidation, the investment account should be 0. So our receivable, since it was a negative, we're going to have to make a receivable a negative. It was below, fair value was below book value. We'll have to put that as a credit. Buildings and equipment. Inventory, 220. Building and equipment was 100. And patents and technology, 500. In process, R&D was 100. And we also need to put in here goodwill. And our goodwill was 190. Yes. Minus. Now, the other consolidation entry we make is S, and it removes the fair value of the investment and capital accounts of Richmond, our subsidiary that we purchased. So, what you'll do is you'll put the capital accounts of Richmond, common stock, additional paid-in capital, and retained earnings as of 1/1/11. Plus net of income and expenses. Okay, our common stock account was Richmond, 220. Additional paid-in capital on Richmond, was right here, 100,000. And our retained earnings equals, and it's 130,000 minus 900,000 in revenue minus 750. 750,000. So we're taking this account plus this account plus this account, and it's plus. So that gives us 280. So checkpoint. Our investment balance is right here. Entry A, entry S. Add these all together. If we did it correctly, we should get 0. Good deal. Okay. So I'm going to color code these. I'm going to make this yellow, and I'm going to make this red. Make it red. Okay. So we need to put these as well as all of these onto our consolidated worksheet. Now it was pre-set up for you. So we need to take all of these journal entries, we'll call this part 2. Okay, so net income, Richmond. So I'm just going over to this information given from the book, and I'm putting this in Richmond. Retained earnings. So here's the retained earnings as of 1/1 for Miller. That's our parent company. Okay, so then we take the net income, but we're going to actually have to adjust these expenses because these were given before the consolidation, and we actually had more expenses, right? So I'm going to go in here and I'm going to find in part 2 the additional expenses we had, and that is the accounting and legal fees. So we're going to add that $20,000 to expenses. So instead, our new net income is $2,580,000. And we need to find our parent companies. retained earnings. Okay, now Miller is our parent company. So starting cash was given to us, which is 600,000, right? But then we need to subtract the journal entries that we made in part 2 that affect cash, which is the additional paid in capital for the stock issuance costs and the accounting and legal fees. We need to subtract that out. So this cash balance has already been changed. Because remember, when we're making the consolidated worksheet, we need our parent company reflect transactions that really happened. Receivables. Inventory. Investment in Richmond. This is how much we paid for Richmond. So in part 2, when we made the journal entry, investment in Richmond, there we are. Buildings and equipment. This is Miller again, our parent company. Goodwill. This came from the transaction here. And I put the goodwill in there, but we're not putting anything here. It'll happen in the consolidation journal entry. Then we have unpatented technology, R&D asset. See if we have any of these on our parent company. Nope, we just have AP. Notes payable. We did have contingent obligation from the purchase, right? So this, 100,000. And our common stock, let's see here. We had common stock of this. We need to add the common stock that we issued right here, million. And since these are already in negative forms, we're probably going to have to subtract that. Yes. Then additional paid in capital. Up here, additional paid in capital minus, what did we pay additional paid in capital? There we go. We take the new retained earnings from above, which is adjusted for the fact that our net income has now changed because we had more expenses. I just got to put this in a negative form because credit balances are represented by negatives here. Now let's see. Total asset. Now I'm off by $10,000. And the reason I'm off is this additional paid in capital. I added the 600, but what I didn't do is this $10,000 additional paid in capital for the stock issuance cost. I'm going to add, because remember we're in negatives, which means I'm really subtracting from this, and I need to take that away. So this balance has been adjusted as well. Our common stock has been adjusted. And this is new. Alright. Now we have Miller's starting balances adjusted for the actual transaction that took place in purchasing Richmond. We need to put Richmond's book values. Remember, we're putting book values here, not fair value. So Richmond's book value, cash. Their book value on receivables. Book value on inventory. They don't have any investment enrichment with themselves. Book value on equipment. These goodwill, unpatented technologies, and R&D asset or in process. So we'll add these up. Now we need accounts payable. We need notes payable. We don't have the contingent liability. We need their common stock book value. Common stock book value right there. We need their additional paid in capital book value. And we need retained earnings from above. Alright. Now, when you're making a consolidated worksheet, we've already made the journal entries for consolidations in the A and S that we made on part 2. Now we're going to translate them here. If it's a debit, put it in the debit column. If it's a credit, put it in the credit column. So, this is a credit for receivables. So I'm going to go find receivables, and I'm going to put a credit here. Okay. Then, this is a debit. I'm going to debit inventory. Then I'm going to debit buildings and equipment. Then I'm going to debit unpatented technology. Then I'm going to debit in-process R&D. And then I'm going to debit goodwill for $190. And then I'm going to credit investment enrichment. I'm going to do the same thing for here. Now I'm going to debit common stock. I'm going to debit additional paid in capital. I'm going to debit retained earnings. And I'm going to credit investment enrichment. Now, when we do consolidated totals on revenues and expenses, we do not do the subsidiary because this revenues and expenses that we did for the subsidiary, this 150, is already included in retained earnings, and we're going to get rid of it in a different location. So we only take revenues and expenses in the income from our parent company. Same thing with retained earnings and the income here. Okay, now we're going to add these all together for our consolidated worksheets, plus the debits minus the credits here for assets. And this one is going to be minus this, minus this. And this one should let's copy in the formula instead. Same thing on this one. This plus this plus this minus this. Okay, so let's see what we get for assets. We add these together. The formula stays the same. And good news, we're balanced. So when you're done here, you should only have the value of the parent company in the consolidated totals for common stock, additional paid-in capital, and retained earnings. That's because in the consolidated total, we purchased Richmond, so their common stock no longer exists. We own it, and they're just keeping it on their books. So that's why we have to make this consolidation entry S. Now, for consolidation entry A, we wrote on the fair values, so it should be the book value plus the book value plus the difference, which makes it fair value for Richmond. And that is a consolidated worksheet.